Morning, everyone, and welcome to the first ever HouseHack earnings call. This is pretty exciting because it's a big first for HouseHack, and it's also something that small venture capital style startups usually don't do. But you know me, I try my best to be as transparent with everything as possible, and everybody knows there are ups and downs in business, but boy, this is a really exciting moment because we think we are delivering really exciting news. In addition to that, it's the first time that we are doing not only a public earnings call, but it's just something unheard of. And we think more businesses should do it, especially in the private capital space. So that said, comments in today's call are based on predictions and expectations as of today. Actual results could differ materially due to a number of things or uncertainties, including those mentioned in our recent filings with the Security and Exchange Commission, the SEC. Okay, with that said, let's get started. So HouseHack, as a reminder, began operating in August of 2023. Because if you'll remember, we began fundraising in late 2022, but we said we weren't going to begin operating until Q3 and Q4 of 2023. And folks, I'm pleased to announce that is exactly what we did. And in the last 1 year and 8 months, we had a simple promise. Invest in us, and we will build a team to build and buy high-quality real estate, renovate it, and or develop it. And in the future, we'll work on repeating the process through strategic sales and hopefully a future IPO. In just that 1 year and 8 months, we deployed over $50 million of real estate into markets that were not affected by the COVID bubble phenomenon. Markets in parts of Florida and Texas, for example, are currently down 25 to 30% since we began our exploration of which markets HouseHack should begin investing in. We've also seen some markets suffer even worse declines. Whereas if you compare to the markets that HouseHack chose to invest in through the research that myself and my team conducted, in the 20 months that we've been operating and since we started collecting investors, we generated over $10 million of equity for investors through our real estate acquisitions, and we purchased in markets that have not seen declines. They have seen appreciation through Q1 of 2025. This means we now jointly own a real estate-backed company with over $60 million of real estate assets with not a single dollar of bank debt. Now, the haters probably won't like that, but fortunately, there are very few of them. Because back when we started in 2022, everybody said it would be impossible for us to scale buying wedge deals. And that's exactly what we did. We spent 50, and now we have a portfolio worth over 60 with zero bank debt. On top of that, we are super uniquely positioned for whatever may come of the economy. Should we end up hitting a wall in June or July because of empty shelves or whatever drama may happen, or should we end up in a soft landing, it doesn't matter to HouseHack. First, should we fall into recession, we believe we're going to be able to strategically deploy the $12 million of cash we have available now into strategic opportunities and in markets we believe maybe are bottoming out in the future. Maybe we'll have an opportunity to, at some point, buy the dip in Austin, Texas, or Florida. We'll see. Remember, I spent 16 years growing up in Florida, so I've got a lot of strategic insights about Florida and where to buy and where not to buy. That said, we will also be very patient and strategic with our acquisitions because we want to see how markets play out in the second and third quarter of this year. We expect to go buying again towards the end of the third and fourth quarter, though we'll keep that optionality open. Should we execute a soft landing, we will continue to deploy capital where it makes the most sense. At the moment, the highest value opportunities that we see while we wait with our opportunity of cash is planning and developing our accessory dwelling units for some of our existing properties. For example, we acquired a downtown 4-unit apartment building and received city approval for up to doubling the size of that apartment building. We just broke ground on our first of the 2 units, which are already approved, and expect the second of the 4 units to be approved shortly. That means we'll be turning the 4-unit apartment building into an 8-unit downtown apartment building, not only providing more reasonably priced housing for Americans, but also substantially increasing our returns on the deal. A high-quality rental property is like a single-family home or an apartment building in a high-quality, low-turnover area, usually with higher appreciation, more insulation, will often yield somewhere between 3 to 4.5% in cash flow without any kind of wedge deal. Our internal cap rate is actually closer to 5% because of our wedge deal model. We're buying properties at a 20% discount to what they're actually worth on the market. And of course, we buy them at a greater than 20% discount because we want them to be a 20% discount after we renovate them. With that said, we believe our wedge deal model makes us very unique and is something that most companies aren't willing to do. Therefore, not only are we often buying for 20 or plus percent below market value, we're insulating ourselves from market issues and cushioning us, enabling us to grow even faster. Our ADU projects represent roughly twice the ROI of non-wedge typical acquisitions, such as what our competitors might acquire. We have plans in progress to additionally turn an 8-unit apartment building into a 16-unit apartment building, then potentially turn a $1 million home in San Diego into a $1 million home, plus 3 ADUs, which could substantially increase our return on investment for HouseHack investors on a project that was also a substantial wedge deal. So now all of a sudden, we are providing households for 4 people, whereas previously the market was providing a household for 0 people because the house was uninhabitable. And see, remember, that's what HouseHack exists for. We don't take homes away from people. We provide quality housing and great landlording to Americans. We're an American company through and through, and we provide a social good. We take messes, filth, damage, and uninhabitable properties, and we turn them into high-quality rental properties. When we build, we accelerate that mission of providing high-quality homes. We expand the capabilities and hopefully, knock on wood, the valuation of HouseHack as we continue to diversify the company. Somebody in the chat is like, this is pre-recorded. It's actually not. Welcome to the first live stream of a HouseHack, but we'll be getting to questions in a moment. This is the early part of the earnings call. So you in the chat technically might not be used to listening to actual formal earnings calls where a CEO makes an opening statement, then you get into the financials of a company, and then you get into the Q&A. We're not at the Q&A yet, if you haven't noticed. That's let's continue with the remarks. So remember, we are not just a property manager, a renovator, a wedge deal hunter, a developer, or all of these things. We believe in the future, we are also going to be a provider of zero-fee real estate funds, which will enable us to multiply our efforts substantially. And so we're really excited about the future and what we're able to do in the future. That said, in August of 2024, just 1 year after we first raised money at $1 per share, we received an independent Wall Street evaluation that we could IPO in January of 2025 for between $1.40 to $2 per share, representing a 40 to 100% increase in the value of day one investor shares. That was just 1 year after we began operating, and I'll tell you, our situation has substantially improved since August of 2024 when that valuation was conducted. You'll see in our financials that we have substantially cut expenses and increased to now EBITDA profitability, which we'll talk about and show the financials in just a moment, and then we'll be open to Q&A. Today, we are raising money again. We are raising at the low end of this range at $1.40 to both accredited and non-accredited investors. And we're offering a 5% yield for the investors investing at $1.40. A lot of our original $1 investors are also investing in the $1.40 round, picking up that 5% yield through conversion. And then both investors will have whatever upside beyond this. We actually think if we're valued at the high end of August's valuation today, people who are investing today are investing at a 30% discount to the high end of our August valuation. And quite frankly, I think we're worth a lot more than that today. But then again, maybe that's CEO bias and CEO optimism. That said, we believe that HouseHack, with just 1 year of full operations in 2024, and now 1 year and about 8 months of operations in total, just a first full year in 2024, has done a lot to calibrate our systems and operations. And our cash flow in 2024 was negative. It was negative by about $2.5 million. 2024 was extremely expensive, and we do not expect to repeat a year like that. 2024 was a startup year. It was our first full year in operations. In my opinion, we spent a lot of money on fundraising, IPO plans, valuations, calibrating employee expenses. Fortunately today, by our 20th month in existence, we are proud to announce that we are EBITDA profitable, and we generated over $10 million in equity for our shareholders through the wedge deals that we acquired. This means that while, yes, we had expenses in 2023 and more expenses in 2024, we well exceeded our expenses, in my opinion, by at least a factor of 2 in the equity we generated for investors. We also today reduced our operating expenses and expanded our gross margin, both of which you'll see the numbers of in our financial segment in just a moment. This is why we think our valuation is even greater today. See, when our valuation was conducted in August of 2024, we were in the midst of essentially a valuation firm looking, oh, wow, you guys can buy wedge deals, but your expenses are a little, on the high side, but you're still producing way more money with wedge deals. Well, today we look and go, wow, EBITDA profitable and able to do wedge deals like this. This is why we think our valuation today is likely a lot higher. Obviously, no guarantees. But the way I look at it is I see HouseHack as my Berkshire Hathaway, a company where we build on strong foundations, take low risk, and expand over decades. I'm not here for a year or two and some flash in the pan AI startup. We are a real company backed by real assets. We're grateful for the work of our incredible team, Ken, McKay, Eric, Jim, Bill, Ross, you name it, our vendors, our tenants, and everyone else involved who works with or for our company. This wouldn't be possible without you. Now, some of you don't just put in 40-hour weeks, you put in 50, 60, 70 hours, and you believe in the vision of HouseHack, and so to those of you, thank you. Now, remember, my goal is to turn HouseHack into that Berkshire Hathaway. So as a result, we need to have really strong financials, and that's what we're going to jump into now. Turning to our financials, our rental income more than doubled year over year to just under $600,000 in Q1 2025 at $598,133, representing a 116% increase in our gross revenues. We also improved our gross profit margin from 56% in 2024 to 63% in 2025 Q1, demonstrating finally more improved in-house property management efforts as we scale the business. We continue to improve this as well. I expect that margin to be even higher in the future. In Q1 2025, we turned EBITDA profitable despite having over $6 million of real estate in development, not yet producing any yield. See, when we buy land or when we spend money on construction or plans, we're not able to reap any benefit of that producing asset yet because it's not yet a producing asset. This, we expect, will increase our rental revenue even more and our margins even more in the future. In addition to that, we have $12 million of cash on the sidelines, which due to the timing of investments and investor contributions isn't yet fully demonstrated in our interest income for Q1. That's because as investments come in, they take time to clear while we still owe interest on those investments, but don't yet earn an offsetting money market yield or rental revenue yield, most of which we expect to deploy over the year after Q3 of 2025. Operating expenses also fell dramatically. So remember, operating expenses are expenses after our costs of goods sold, such as property taxes, insurance, maintenance, management, utilities, reserves. Those are all part of our revenue minus costs of goods sold. Okay, that's part of our 63%. Now, our core administrative expenses, which are expenses such as IPO grade PCAOB audits, these are very, very expensive, mind you. These are rigorous audits that the company goes through, probably the most rigorous audits that you can get as a commercial company. This is where auditors viciously look through our leases, our purchase agreements, our conflicts of interest, any material concerns with the company. Well, we successfully completed our PCAOB audit for 2024, and we look forward to continuing our compliance with the highest standards in commercial accounting. Our PCAOB audit expenses and our IPO level expenses are and have been reduced significantly. All of our operating expenses have been reduced by 42% year over year. And so now let's turn into actually looking at our Q1 income statement. So our Q1 income statement is right here. This is our Q1 income statement. You could see our total revenues of $598,133. You see our gross margin of 63%. Depreciation, which is obviously not an actual expense, of $228,000. This is our OpEx. A lot of this also related to the scaling of our company. And so we believe that we could probably substantiate somewhere around 2 to 4x the revenue that we have with the OpEx we have today. Remember, our operating company is a small company. HouseHack is still a small company. And as we grow to more properties, our OpEx butters out to more and more properties and revenues. This ends up leaving us with an interest expense and depreciation add back in, so an EBITDA of $37,000. If you simply add back in depreciation of $228,000 in Q1, let's see here, 273 minus just the depreciation, we're operating at a Q1 loss of only $15,000 per month, which is very low for a company that's still deploying over $18 million of productive assets. This, in my opinion, is fantastic, and it represents a significant improvement over the financials of 2024, and it makes us really excited about where we're going into the future, given that so many startups today, especially in the venture capital space, are just straight up money-losing, cash-burning, no hope of being profitable companies. We're very, very excited. Look at, for example, I probably will make a separate video on this, but what I like to do is look at, for example, the numbers that you find over at a company like Boxable, which sells manufactured homes that, in my opinion, they misled investors on believing that these manufactured homes would end up being homes that you could actually sell as an individual property. When we look at financials of a company like this, we see a company that's been in existence for 8 years that has a gross loss of $11.5 million. That's a gross loss. Revenues of just 3.3, cost of goods sold of 15. That's Boxable for you, just as an example. This is a company that's also doing a Regulation A fundraise, and I've interviewed the executives at this company and made videos on the channel about them. And when you look at their total loss from operations, they're $52 million for the year in 2024. And it shows you a company that's generating $3 million of revenue with a $52 million loss at Boxable is raising money and promising venture capital investors hopium, but they're nowhere even close to EBITDA profitable, which we are. And we've only been operating for 20 months, whereas Boxable has been operating for 2028, since 2017, so about 8 years. Now, turning to our Q1 balance sheet. If you look at our Q1 balance sheet, you can see that we have our real estate cost basis of roughly $50.7 million. We believe that real estate is probably worth well over $60 million. I would guess at the moment, off the top of my head, probably somewhere between $62, $63 million. We'll call it 60 just to make it simple rounding, call it 60.7 to show that simple 10. That does not show up on a balance sheet unless, of course, you sell that real estate. So therefore, we have an asterisk and we say that management current estimates of these properties, based on the appraisals that we've gotten or fair market value comparison approaches or whatever, is over $60.7 million. Again, I think it's probably closer to 62, 63, but that's my opinion. Current cash and short-term investments available of about $9.6 million. We do have convertible bond liability of 12.7, but what you'll find is that upon conversion, we'll actually have no long-term debt. So when our convertibles hopefully convert to stock in the future, where our shareholders would be the beneficiaries of the upside in that valuation, we would essentially have $200,000 of liabilities, and those would just be current liabilities, bills, property taxes to pay or whatever. We have no bank debt. We are entirely a cash-based business in addition to convertible bonds. Now, this is a March 31st statement. We currently have a cash position of closer to about $12.5 million. So our cash position is even higher than what's demonstrated in our March 31st Q1, end of Q1 financial statement. So those are our financial statements. Now let's turn to some questions. There are some questions that were submitted to us via email or text message through our community link, and then we'll get to the some of the broader questions from the live stream. So question number one, Kevin, what is your bear, base, and bull outlook for HouseHack? Okay, so I just have to disclaim this, that obviously this is my opinion. I'm a CEO. I'm biased. I think this is my little HouseHack Berkshire Hathaway baby. I'm very, very excited about it. And I think there are endless things that we can do, not just over the next years, but the next decades. So no guarantees, not personalized financial advice. Don't invest in based on this. Make sure if you're ever thinking about investing, you read our SEC filings and all of the solicitation material. That said, I personally think that simply as a public real estate company in the future where we diversify into wedge deals, which you haven't really seen before, I think based on our original valuations, I think to me we're an easy 3x in my bear case scenario. That's my opinion. That's because when we look at comparison real estate that doesn't buy wedge deals, they're selling for book value multiples of anywhere between 1.8 to 2.5. And I think with wedge deals included in this, as well as the momentum that wedge deals create, we can be substantially higher than this, especially when you add in ADU development. Our base case, in my opinion, is not just adding in ADU development and real estate diversification and wedge deals, but also broader developments, so spec homes or even a smaller development communities. So we add more housing for communities as well, more in the direction of like a Lennar or Standard Pacific or whatever. I think we could potentially be somewhere around a 4 to 5x. That's my opinion as a developer. And in my bull case, this is the harder part. And this will really involve building out a zero-fee competitor to platforms like Fundrise, which also comes up a lot about in sort of our Q&A. I think we can create a company that's worth 10 to 20x or maybe even substantially more. That's obviously my opinion. Fundrise, for example, charges substantial fees when you actually look through all of their documents. You look at a 0.15% platform fee, which they advertise to everybody, but then in their documents, you have another 0.85% for asset management, 1% for construction, 1% acquisition disposition, 1% lending, 3% liquidation, and more. You should really go through the documents of these competitors. They're really anything but zero-fee real estate. And part of that is because Fundrise, at least based on their last financials that I looked at, spends a lot of money on very expensive advertising. See, one of the benefits HouseHack has is HouseHack has never spent a single dollar on traditional advertising. And this is the value that we can provide not only through our community, but with our community, and we think gives us a really big competitive advantage to expanding our business in the longer term. So no guarantees, but we think that zero-fee platform competitor that we're creating is a significant game changer that comes with very, very little risk, in our opinion. The next question that came up was, what was the hardest operating expense lesson? So to me, that is don't hire too fast. When we had to deploy $50 million of real estate, it was easy to believe that we needed a massive team, which I found that we are actually much more efficient, not only on a margin basis, but an expense basis, with a more efficient SEAL Team 6 style team versus having like an entire platoon. We can move a lot more nimbly, rapidly. We can learn more, coordinate more, work better together. We're much more synergistic with actually smaller than a massive team. And so I think this really, not only do the folks on the team deserve significant recognition for this, but it's also a useful business lesson for anybody watching, that sometimes smaller teams can be substantially more agile and profitable than larger teams. Another question that comes up is, when does HouseHack plan to go public? Obviously, this is entirely market dependent. One of the reasons I didn't want to go public in January of 2025 was because I felt the conditions for a very bad market coming up were present. It was also one of the reasons that after returning over 24% for investors in my exchange traded fund, which was a separate venture, I decided to close that venture fund down, not only because I wouldn't have the flexibility to hedge for a downside, but I wanted to return that cash to shareholders, which we did in the exchange traded fund, again, a separate initiative from HouseHack, which now frees me up and closes down other distractions and lets me solely focus on HouseHack. So while that was a great success, and there were lessons that were learned in it, especially with the company that we were working with that I wasn't very happy about, won't mention them, we can now focus entirely on HouseHack. And so we weren't really excited about the market in Q1. And sure enough, we've gone through one hell of some drama in March and April in public markets. So we're really grateful we decided to delay our IPO for HouseHack. But now we can say we know what it's like to go through a significant portion of the IPO process, the pre-IPO process. And so we think it should be relatively easy for us to go public between 2028 and 2030. But again, that's going to really be market dependent. And I think by then we'll be through whatever this craziness is that we're going through right now, whether it's a soft landing or it's a recession that seems to be a coin toss right now. Either way, we think we're really well positioned to execute very well in either scenario, whether that's buying markets that have bottomed out in the third and fourth quarter, or maybe even next year, depending on how long the recession goes, if there is one, or just continuing to operate on a cash basis in the soft landing. Obviously, if there's a recession, because we have no bank debt, we actually think we could rapidly expand the balance sheet of HouseHack. We think we could potentially crack the egg of our real estate and cash and leverage it with cheap bank debt should there be a recession and should the Federal Reserve panic with low interest rates. We actually think we could probably 4x the size of our real estate portfolio nearly overnight without having to, I mean, that's obviously an exaggeration. It takes time to deploy real estate, but it'll happen fast and rapidly to finance it. But we believe we could do that without significantly expanding our operating expenses and rapidly scale into a cheaply leveraged portfolio and a conservatively leveraged portfolio without, again, significantly impacting our margins. That's just my opinion. So, but anyway, yeah, 28, 2030, I think would be relatively easy. Based on historical performance, what is the supply of wedge deals at a 20% discount? So I've answered this one very regularly and very consistently, that there is no supply shortage of wedge deals. There is no shortage of homes that are unlivable that companies like HouseHack can make livable and provide housing to people and increase the housing supply. There is no shortage of that. There is only a shortage of capital. And that is why we're fundraising, because we have not sold any of our properties. So if we don't sell any of our properties and we don't take out debt, we don't do anything unless we fundraise again. And if we fundraise, we can continue to expand the flywheel of HouseHack until, of course, we get to some form of zero-fee real estate platform where we strategically leverage or sell some of our assets. Are you experiencing any rental defaults? The answer to that is no. We have 0 vacant units as of today, May 11th, 2025, and we are 100% paid and current for May of 2025. Can we invest in round 2 if we invested in round 1? And if so, how's that different? So yeah, we kind of hit that already. Yes, you can invest in round 2. I think one of the examples or sort of docs that I like to use is I like using this sheet here. HouseHack, not only on the househack.com website can you see our the properties we have and the wedge deals we've done and pictures of them, but we think HouseHack is really unique because you can diversify away from really rich, in my opinion, stock market valuations, diversify away from VC AI valuations, you diversify into American real estate. We're not really exposed to tariff risk. People are like, oh, but what about construction costs? Ironically, construction costs have been going down because of the tariff risk, because there's so much uncertainty that fewer people are building. And when fewer people build, contractor margins actually go down. So we don't actually think we experience tariff risk. We think contractors experience tariff risk. That said, we are an opportunity to diversify away from longer term treasury risk while still earning a 5% annual yield. And you diversify into fixer-upper discounted real estate. So that's our POV, and we think it's a great opportunity, and we think that's why a lot of people from round 1 who believed in us when we were literally nothing are also looking at increasing their investments. We think that's a really good testament, and we've got almost 2,000 shareholders, which is really phenomenal for the size of a company we are. It really shows that the support for what we're doing and the success that we're building is ubiquitous. There's always going to be the noisy sort of 1% or the loud, social media creator who inappropriately wants to, bag on HouseHack or insinuate whatever. But for us, the proof is in our pudding. We're not somebody trying to get views off of HouseHack's name. We are a company that is PCAOB audited and compliant, one of the most rigorous auditing standards for righteousness in commerce. We are EBITDA profitable, and we have the infrastructure to support, in my opinion, 3 to 4x the real estate revenues that we currently have. And so we're really uniquely positioned for growth. And that's before we even get to what I think is our 10-20x opportunity, which is our zero-fee platform, our Fundrise competitor, which we're really, really excited about. So with that, I'm going to jump over into some of the YouTube questions here. I see somebody here says, let's see here. You can't really over leverage real estate. I think you're responding to somebody else's, discussion here. Yeah, I mean that I think that's self-explanatory. Okay, so what about continuity plans? Yeah, I mean, look, obviously, this is a small company. We're a great team. We're sort of a SEAL team, if you will. But we've got great people involved. Lauren's involved. My father-in-law's involved. Ross is involved. We've got a great team in-house with our property management and acquisitions. I'm personally very confident that HouseHack could continue to operate in a profitable, very profitable manner, in fact, even if I weren't here. Now, obviously, just like, an Elon Musk at Tesla, there's always a risk. You've got to have that vision and the founder leading the change. But I think, unfortunately, there's just always going to be a key man risk with a company until, they're very mature. I mean, I would even argue there's key man risk at Facebook. I mean, Mark Zuckerberg is most people don't know this, but Mark Zuckerberg basically owns the majority of all voting shares. And I actually think, that's a good thing. It's one of the reasons why Meta has been so flexible and why they've returned, such great returns to their shareholders. Whereas Elon Musk wishes he had more controlling power, and is one of the reasons why potentially Tesla's performance hasn't been as great as Meta's recent performance. That's just my opinion. But great questions, great questions. So, yeah, the current minimum investment, which we don't expect to change, is $20,000. I would rather HouseHack focus on an area of the market they knew well before taking risks outside of the bread and butter. Yeah, and that's what we're doing right now. HouseHack has done very, very well into markets that we are experts in. So we're very, very excited about what we've been able to do with the deployment of capital. And in the future, should we expand into any new market, it would be very, very slowly at first. So are all of the houses in California? No, not all of the houses are in California. We're also exposed a little bit to Utah, but a lot of our real estate is either NorCal, sort of by within an hour of Tesla Fremont, San Diego, a little bit of Ventura, some Utah. So we're in a relatively close radius, and we think we have a really, really high quality portfolio. A lot of people, I always think it's funny. A lot of people are like, ew, I don't like California real estate. The funny thing about California real estate is politicians in California are so bad at enabling housing growth that you don't end up getting that oversupply of real estate that you see in sort of red states like a Texas or Florida, where you could build so much that you oversaturate with building, and then you create a real estate market crash, like the 20 to 30% declines we've seen in some of these markets because of overbuilding. It's a totally different market. Whereas in California, politicians limit how much you can develop substantially. And then we have fires, which destroy existing properties as well. We're fully insured, mind you. So, it doesn't matter to us because we just get a big check if a property burns down. Knock on wood, nobody has ever hurt. We've never lost a property to a fire, and we don't think we're in any high fire hazard areas. But when you think about it, you're in a state where supply is actually shrinking and politicians don't let you expand supply. That actually increases property values for what's left. On top of that, our property taxes are based on acquisition price. So based on wedge prices, not on market value like they are in other states. So it's kind of remarkable what politicians have done in California. Has really done some really incredible stuff. So what differentiates your fund from a company like Open? So we're not a fund. Okay, we are a real estate corporation. We're a company. Again, we're like a I hope to be the future style Berkshire Hathaway, starting with something we're really good at. We're not starting in furniture. We're starting in real estate, which we think we're really, really good at. But Open Door is, in my opinion, a very low profit house flipping company where, the goal is really just to try to arbitrage the real estate commissions. They're basically, in my opinion, often overpaying for real estate, doing very low quality work. I've made videos on this before, and then flipping the real estate to kind of arbitrage the real estate commission. So to me, they're more of a real estate commission play than actually, what we do. So that's my opinion. The HouseHack portfolio, you can actually see it at househack.com. And you could sort of see a list of all of the different homes or properties over there. We don't put the addresses out mostly just because today is such a divisive day and age that we don't think it's wise for property addresses to be potentially, a target of people who are, on social media or whatever. So because of that, we keep that down low. So somebody who writes here, bro is legit. Well, thank you. Yeah, I mean, this is pretty exciting. Shouldn't you be taking Lauren to breakfast instead of live streaming? I think Lauren is enjoying a Sunday morning sleeping in. It's very rare that she gets to sleep in, so I think that's one of her rewards. But don't worry, there'll be plenty of time for Mother's Day. Happy Mother's Day, by the way, everybody. So, what are the plans with the equity? I think you're referring to our cash flow or the money that we're raising. And again, that goes to deploying that capital into opportunities like more wedge deals in Q3, Q4, just like we said when we created the company, or our ADU developments or our spec developments, or whatever. Like wherever we think we can get the highest yield, where with the lowest risk, in our opinion, is the game plan. So yeah. Okay, we've gone through the balance sheet. Should we show you that? That should answer your question there. You could scroll back if you want to see that. How long is an investment in HouseHack locked in for? Well, I mean, technically, I believe I have this correct, but fact check me on this. A non-accredited investor has no liquidity restrictions, so you could sell your shares right away. A Regulation D accredited investor, I believe, has a 6-month restriction. Fact check me on those timeframes. But basically, if you wanted to sell your shares to somebody else and you knew somebody who wanted to buy them, you could sell them. They're unrestricted shares. Now, the best time for liquidity, in my opinion, would be when the company IPOs in the future, because then you could just sort of like you transfer your ownership in HouseHack to your stock brokerage, and let's say that's Robinhood. The HouseHack shares would just show up there. Whatever the ticker would be, say it's HH or whatever, and then you grab it and you just go, okay, well, I want to sell. You just swipe up the amount you want to sell. That's obviously when a company goes public, and that's one of the benefits of being public. Is that rapid liquidity. So what interest rates are you targeting to refinance properties? I mean, I think they should certainly be under the market area, typical cap rates. So if you're investing in an area with a 5% cap, your debt should be under 5%. If you're investing in an area with 4 caps, your debt should be under 4%. I think that's usually a really good rule of thumb. I personally have the mindset that in the longer term, interest rates will actually be even lower. So, probably by 2030, I think our interest rates will be substantially lower. Yep. So can you explain a home purchased by HouseHack from Kevin Paffett? Yeah. So we had a 4-unit apartment building with basically plans ready to go on a 2-unit ADU expansion. This was probably, I mean, we had multiple appraisals on this property, and I think the average appraisal that we had was somewhere around, I can't remember. It was like, I think we had 3 or 4 different appraisals, and our board reviewed this. I was uninvolved in even choosing the purchase price of what this would sell for because I didn't want to have anything involved in it. But it's the only property that HouseHack has purchased from me. It was, I think it traded for 1.6. I think it appraised somewhere 1.8, 1.9. And the reason I sold it was because I saw the potential of turning it from 4 units into 8 units, which is what HouseHack is doing. And I don't want anybody to think there's a conflict of interest. So what I actually think we did is we de-risk conflicts by selling it at a pretty large discount to HouseHack. Mind you, it was already renovated. Like it was already renovated with the HouseHack formula. So like HouseHack didn't have to go in and renovate. It was already renovated. It was like, cool, operating property with great tenants. It was done, right? And then it got all the optionality of building 2 or 4 more units. So HouseHack is getting all of the benefit of, our ADU returns are probably somewhere between 6 to 8%. I think on that deal, they're somewhere around 7.1%, which is really good. And so we're going to do a lot more ADUs. But so I was uninvolved in that process. It sold for probably a $200,000 to $300,000 discount to its fair market value, probably even more of a discount now given the ADUs that are being built on it. It's a really great property, and I actually think it deconflicts me because my goal is to get to have basically no personal tenants. So like I personally want zero exposure to tenants because I want everybody to know that my focus is HouseHack. Like I feel like just the amount of even like outside efforts that go into HouseHack to me are my way of justifying or showing that HouseHack is my long-term baby. And I want everybody to believe that that's true because that's my vision. You know, I want to be here in 30 years doing earnings calls like this. So hopefully then as a public company, you know, goal is to be a public company by 2028 to 2030. But that's my goal. So that was actually a really good deal. I mean, that was a slam dunk wedge deal. I basically donated, I feel like, you know, that loss to HouseHack because again, I want people to look and go, all right, this guy's seriously all in on HouseHack, you know? So yeah. But people make fun of my my LLC names, you know. You should never use an LLC that's your name. I mean, have you never taken a course on from my real estate investing course? I literally in my real estate investing courses say, you know, when you make an LLC, you should never title it with your name. You should title it something stupid like Mickey Mouse Trust or, you know, Toxic Wasteland or whatever, you know, just to, because there are always like prying eyes and attorneys or whatever, you know, so I think not only is there comedy in it, but there's also anonymity in it, but, you know, then there's also hopefully some practical effect in it. But this is something that I've taught for over 10 years in my courses. You know, what you'll find with me is I'm actually really consistent. You know, people always joke, they're like, oh, you know, Kevin changes his mind or whatever. No, I adapt to business conditions. I adapt to macro, but I'm very, very consistent with my principles. Buy wedge deals, buy quality wedge deals, protect the base. HouseHack has such good protection. You know, we have no bank debt. We have, in my opinion, it's like, obviously, you know, the SEC has to tell you via disclosures, and the SEC, you have to say any company could exhibit, you know, loss and go bankrupt. But like, how stupid do you have to be to bankrupt a company that has no bank debt and has $60 million plus of real estate, again, with no bank debt and what, $12 million of convertibles, where we literally have $12.5 million of cash, you know, rough numbers right now. Like that's, you have to be pretty dumb to screw that up. But again, that's, you know, that's my opinion, and there's risk with any investment. So yeah, that's really exciting. Yeah, that's a good question as well. Somebody here has talked about lending. You know, I'm always a big fan of limiting lending. You know, we have never lent. I think in the longer term future, there are some opportunities in technology and fintech and with home equity lines of credit. That's probably more for after any kind of recession or market kind of correction, should there be a larger one, mostly because you don't want to lend going into a rough environment. But those are longer term, you know, small capital deployment tests that are not in the near-term book for HouseHack. So there we have it. This was a very good, about $43 million, or sorry, $43 million. The company was $60 million. 43-minute first ever Q1 HouseHack earnings call, which is really, really amazing. So I appreciate you all very much for being here. Thank you so much. Hope you enjoyed looking at our financials. EBITDA profitable. Congratulations to the company and everyone else. And somebody here says, how Kevin has been consistent since 30,000 subscribers. He has been consistent. I've been with Kevin since 30,000 subscribers. He's been consistent. Oh, thank you so much for that, Rambler. I think that's really nice. What areas of Florida? To be determined. But remember, I spent 16 years growing up in Florida. I know a lot of different markets in Florida. You know, I don't like pre-revealing the markets that I'm targeting, but there's some really juicy ones that I'm looking at. Anyway, thank you so very much for being here. Appreciate you. If you're interested in investing in HouseHack, go to househack.com. Remember, if you invest in the current non-accredited or accredited round for our convertibles, you are investing at $1.40 per share. You get all of the upside, 100%. There's no premium. It's not like MicroStrategy where they're selling you shares at, you know, $400 on their convertible, but you only get the conversion to shares if it's $600 or more, which is, in my opinion, a detriment to you. You get 100% of the upside. And unlike MicroStrategy offering you a 0% yield on their convertibles, you know, or a 0.9% yield on other convertibles, we're offering you 5% as a yield, which comes from our rents, our cash flow, and of course our future rents that we deploy. So we think we have a really good offering. You invest, you get that yield paid to you on a monthly basis through ACH. So again, you get all of the upside above $1.40. You get a 5% yield on an annual basis paid to you monthly. And when we convert and eventually go public, you benefit from all of the upside of the shares. Hopefully, there is a lot of it. Obviously, no guarantees. Read the disclosures we have, read the solicitation materials, the upside risks, the downside risks, and more. And I appreciate you all coming to the first ever HouseHack earnings call Q1. Thanks so much for watching. Goodbye and good luck out there.